Hi folks, Nick Shaheen here, recapping the epic week ending 8/28/2015. So much has happened this week, so many records broken, both ways, up, down. Let's start with Monday, 8/21, 8/24. We had a flash crash. Yes folks, nobody's calling it a flash crash, but I am. On a day you see this happen, you have to call it a flash crash. Okay, we're looking at the cues. Let's go in here. Apple, this was Monday, $92. Down basically 15, 20% eyeball from here in basically minutes or hours, I should say. And then in minutes, losing 15% from where it was opening. On no news, that's just pure sentiment and headline trading. Nothing in the fundamentals changed. That is a flash crash if I've ever seen one. You can look at it in the Q minis, basically the NASDAQ. And you can see we had 3908 down from, let's call it 4,300 eyeball. Those are severe moves. If you wanted to look at the candles themselves, let's look at the Qs, for example. An easy candle to see because we can also look at this. All right. So basically, the Qs at the bottom of this candle right here, 824, from the top of the recent high, is 26%. So we had a 26% correction to the bottom of this candle. So you got all these experts going on for years, months at least, let's say it, maybe years, saying, we've gone so long without a 10% correction. Hopefully we've quieted all of them, because we had way more than that. So that statistic is out of the way. All right, so we had wild swings. So now we have to look ahead. We had wide swings. The Dow traveled 60% of its value in 5 days. It didn't drop 60%. It traveled 60%. So if the Dow was 16,000, whatever it was, it traveled basically 10,000 points in a week. So that is a lot of points. I believe CNBC said 3,000 points in the first 90 minutes. I didn't count them, but I'll take their word for it. That's a lot of points. We're talking hundreds and hundreds of points up, down within minutes in the S&P. So this is just, once in a lifetime, maybe twice in a lifetime of a full-time trader. So we're talking about decades and decades and decades. We've had a flash crash before. Here's another one. We need to find a cutesy name for it. All right, so what else happened? We had major system breakdowns. Every day we heard about something breaking down. First of all, the open on Monday was disorderly. How so? It was totally disorderly. Not everything was open, and the quotes weren't correct. And so who's to say that the drop pre the open caused the bad open, or the bad system breakdowns, or the bad system breakdowns caused the debacle, caused the somewhat red open to become huge crash? But I don't know which came first. We probably will never know, but it happened. And then the next day you find out that, okay, we can't calculate net asset values on mutual funds. So I ask, if somebody called and said, sell my mutual funds, what did you sell them based on? Maybe they didn't sell them. Maybe that explains these weird price movements throughout the week. So the swings maybe got worse because of the breakdowns in systems. Who knows? It happened. I personally could not trade on Monday at the open. I couldn't see quotes. Some I did, some I didn't. I couldn't even buy one option. That's way out of the money. Many platforms. I know only of one platform, Interactive Brokers, I believe, was the only one that was working among the hundreds of people I was talking to. So there's something to be said. Something broke down every day. Even on Friday, we heard Schwab was down for a while. So these are not coincidences. All of these happening on the 1 week. So did they cause the break or the crash, or did the crash cause the breaks? I don't know. I don't care. It happens. So I got to guard myself going forward from it happening. Broker failures. The end result. Let's talk about the end result of the week. So you're thinking it was a disaster week, right? So I switch over to the end result. Ta-da! Green candles. What? Yep, green candles. I'll go to weekly. This is weekly 1 year. However, look how low this candle is. Lowest in a year on volume. So I got to zoom out to 2 years on the Qs to see, okay, it went as low as, this was April 2014 debacle. That's pretty low on the Qs. Small caps were a little better behaved. They didn't even match the October low. They were about eyeball 5% or so up higher. Still, they had to fall. And the S&P broke through the October low. So for that, we zoom out to 2 years to give you magnitude. And volume was huge. So you can see within the last 2 years. So all the trends have broken. Speaking of trends, I've been saying for months that the meander will end badly. And for the last few weeks, I've been saying, yes, we're still traveling in that box. You see that white box? So that we have well-behaved ranges, but we're touching the ends of the ranges too frequently, meaning those swings are becoming more violent and bigger in amplitude. So I've been saying, careful not to get used to them, because when they break, they're going to break big because of that. And sure enough, bam, that's as big as they get. Look at this candle. Broke through everything. Same here, same here. This is the box in the small caps. So we saw this coming. The only trades that really got hurt were the short-term trades that had no recourse. Somebody that sold spreads or sold risk on the weeklies, oh, they got either made a lot of money or they got killed. That's why I avoid them. I try to go long distance. I call them ICBM trades. All right, so what happened? How did we bounce? Well, it was part dead cat bounce, part China QE announcement, add a sprinkle of Chinese government stock market intervention. They're buying stocks in the open market, add a dash of historic oil rip. So the last couple of days in the week, so Thursday and Friday, I'm going to go to 6 months here. These two candles were heavily influenced by oil. Oil had a move that was unprecedented. I believe from low to high in the last couple of days, it's up 21% from its low to high. So it had a huge rip, like a 10-12% day followed by a 6 or 7% day. So let's see here. Yep, 6.5% on Friday. So these moves were huge. 37.75 the low to 46 almost the high in just 1, 2, 3, and 4 days. Huge move. So that has a direct influence on the market. How so? Let's look at the S&P 100. This whole box is, if it's bright green, and it was, so if Chevron is up whatever, 3.5%, this is today. Yesterday they were up more. Then that influences the indices directly. What doesn't influence the indices? Why were they so well behaved? Were the small caps, because there's no one big box that can move the small caps, all right? So oil was part of the bounce as well. You have to recognize that. So know what you're chasing. And what to expect for next week. That's pretty important, all right? So we saw this stuff happen. So what do we expect next week? Based on the open interest, let's assume this is a normal environment where I don't foresee the same thing happening last week that happened on the flash crash happened next week. Based on the open interest, we should meander a little bit. However, I caution any new trades. I am not doing any new trades because there's been price elasticity. Now, once bitten, twice shy, both ways, meaning it's hard to erase this candle out of your memory on Monday. So you're looking at the NASDAQ down 9% on Monday. If the NASDAQ starts red on Monday, you're going to see that flash in your head and say, oh, sell, sell, sell. So, and vice versa, if you're short on Monday and you see an up 200-point day, you're going to say, oh my gosh, we had a 900-point rip in the Dow in 2 days on Thursday and Friday. You know, cover my short, and buying begets buying and selling begets selling. So it's going to be easier to move bigger stints than before because of what happened this week. It's like a rubber band. You stretched it. Now it stretches easily after you loosened it up a little bit. All right, so be careful. What to do? I don't set any new fundamental trades, especially long ones, because even though my fundamentals have not changed, there's sentiment trading and there's headline trading, and they're both in control right now. And somebody asked me, what is sentiment trading? The definition for me is when price changes dramatically based purely on sentiment and absolutely no change in the fundamentals. What does that mean? Well, let's consider Apple, for example. Apple, did they lose in hours the ability to make money from the 110 level or 112 level down to $92 a share? I can guarantee you they did not. Same with Costco. They did not deserve to drive 15%, drops 15% in seconds on the open of Monday based on their fundamentals. The move was sentiment and headline, period. China headline, people felt sold. So if you were able to buy it at 92, kudos, my platforms were locked up. So this is the deal. That's sentiment trading. They're in charge, I step back. Also, we have to, if I had trades in trouble last week, I don't assume that they're going to be out of trouble now because they're out of trouble now because we're recovered. I assume that it may happen again, so I buy them insurance. If I bought insurance, I don't sell the insurance. If I have profits, I book it. I sit back and relax and bring out the popcorn and watch it. So what if I miss a couple of bucks? All right. These are unprecedented moves. So I prepare myself to expect the unexpected, and I manage existing risk, and I don't anticipate the bounce being the final bounce. Okay. So the variables at play, we still have China. We still have the systemic uncertainty. We still have the looming rate hike. By the way, it was much ado about nothing, that Fed event, I believe, because Yellen wasn't there, so I didn't expect them to say anything. And they didn't say anything. In fact, they said, we haven't made a decision yet. Duh. Oil still is an uncertainty. Greece, snap elections in September 20th, and now we have a new party that could jeopardize, that we have to deal with, that they could jeopardize the deal that they have in place. So Brexit is not done yet. We have the QE possible increase announcement next week, which could, because people don't believe that they have enough stuff to buy. So they can say, hey, we want to increase our purchasing speed or power, but if they don't have stuff to buy, what are they going to buy? Also, most importantly, we have technical analysts that say that this drop could repeat very shortly. Technically, I see it. I don't call for it, but I didn't call for the crash either. So even though you don't see it or you don't think it's going to happen, it technically could happen. It invites it, okay? Also, most importantly, the VIX, not most importantly, also important. The VIX is still too high. Yes, today, Friday ended on a down note for the VIX, barely down. It was up most of the day, and this level is second only to the 2008 debacle. If I expand to 5 years, you still won't see a worse day than this one. This was a historic day or month, I think, for the VIX, the historic move for the VIX. And only if I expand to 10 years to include the 2008 debacle that I lose with this VIX level right here. That's it. All right, so the VIX tells me that the market is still scared. However, the candle behaviors say that maybe they're done for now. But I can't use that to trade. I just use it as, hey, hopium, that something's going to happen. But I don't trade. I don't invest on hopium. I trade on hopium if I want to. So if I'm optimistic or I want to be optimistic, I spend a few bucks, small money, on some call spreads. If I own a chunk of stock and I'm worried about, if I own 100 shares of Apple and I'm afraid about it for the short term, I can replace it with calls. So I book my profit at Apple, I sell my stock, and in lieu of my stock, I buy a call out in time, give myself some time, leaps, January, March of next year, whatever is available. I'm still long Apple with that, but at a fraction of the risk. This is stock replacement strategy. One note of caution, I was listening to, I believe, the gentleman who coined the black swan term, Nassim Taleb, and he cautioned that even though the fundamentals now are way better than the debacles of 98, the Fed's out of bullets. So even though I have a big gun and somebody's attacking me with a knife, I have no bullets to shoot at somebody, I'm going to lose. So if something goes wrong, I can't bail myself out with this gun. Therefore, I should respect this sentiment trading potential magnitude. So a bad situation could become a lot worse just because we can't fix it. We have no medicine for it. We have to go out and invent the medicine. So if you have a disease, yes, you may be able to take 6 months to find a cure for the disease. Meanwhile, the damage is done and way bigger than, hey, okay, you got this, here's this medicine for it, and then you're better in 2 days. Remember how long and hard it was to get something done for the QE? And even now, people don't believe it worked. So you have to be respect the potential effect of that sentiment. Okay, so what happened this week for me? Nothing. The thesis did not change. Absolutely nothing changed in my thesis. Exactly the same things. We just had a flare of headlines. So be careful going forward. And if you miss a couple of bucks on the upside, so be it. Sorry for the long video this time. Nick signing out.